Welcome to the deep dive. Today, we're tackling a big one, a real test case for modern corporate finance. We're looking at Strategy Inc. You probably know them as MicroStrategy, ticker MSTR. And the question is this a disciplined new form of value investing, or is it just a massive speculative gamble?
You really have to throw out the old playbook for this one. So just to set the stage, we're working with numbers from December 1st, 2025. The share price is sitting at about $177.
Okay.
Market cap is roughly $51 billion. And the Bitcoin price, which is, of course, critical here, is way up, around $91,000. And, they're not hiding their strategy. They rebranded in February for this very reason. They are a Bitcoin Treasury company now.
And here's the hook, the really shocking thing we found that prompted this entire deep dive.
Yeah, this is the key.
For the first time in years, MSTR's market cap is actually dipping below the net asset value of everything it holds.
That's the anomaly. It's trading at a discount. When we do the math, the stock is trading at something like 0.96 times its net assets.
So you're saying you can buy $1 of their assets for 96 cents?
Exactly. And that should be a screaming buy signal for a value investor, that classic margin of safety. Our mission today is to figure out why the market is offering this deal and if that discount is hiding a major risk.
Part 1, Chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding. So at its core, Strategy Inc. is like a dual-engine vehicle. You've got this stable, cash-generating software business.
Right.
That's the engine.
Right.
And then you have the Bitcoin Treasury, which is volatile, high-octane.
Yeah.
That's the fuel.
Let's start with that engine, the software business, MicroStrategy 1. It's industrial-strength business intelligence. And its real value, its moat, is something called the centralized semantic graph.
Okay, hold on. Centralized semantic graph. Can you break that down for us? It sounds technical, but it seems really important.
It is. Think of it as a data fidelity moat. It makes sure that every single department in a company, sales, finance, you name it, is speaking the same language.
So profit means the exact same thing everywhere.
Exactly. It prevents what they call Excel hell, where everyone has their own version of the truth. Because that software gets so deeply embedded in a company's systems, the switching costs are just massive. You can't get out easily. And they've bolted on AI with hyper-intelligence to make it even stickier.
So what about that counter-narrative, the bear case that the software business is just a melting ice cube?
Well, the Q3 2025 numbers just don't support that at all.
Subscription services revenue, which is the key metric for their cloud business, it shut up. What was it?
A massive 65.4% year over year, $46 million.
Yeah.
And total software revenue grew almost 11%. The engine is definitely not melting.
It's robust.
Absolutely. The engine is healthy, but the real story is the fuel, the Bitcoin Treasury. The philosophy here is simple. Management sees the US dollar as a guaranteed depreciating liability. So for them, Bitcoin is digital capital.
And they hold a staggering amount, roughly 650,000 Bitcoins?
Which is about 3.1% of the total supply cap. I mean, it's a huge position for one company.
Does that concentration create its own risk?
It does, and we'll get to that. But just on value, their average cost is around $74,000 a coin. So the market value of their holdings is almost $60 billion.
And this is all protected by what you call the double moat. We covered the software moat. What's the second one? The capital markets moat.
Right, the fiat loop. This is the real genius of their strategy. MSTR can issue convertible debt with incredibly low interest rates. We're talking less than 1%, sometimes even zero.
Why would anyone buy a 0% bond?
Because they get the equity upside. Bondholders give up the coupon in exchange for a piece of the action if the stock in Bitcoin goes up. MSTR takes that super cheap cash and buys an appreciating asset. It's a brilliant form of arbitrage that almost no one else can replicate at this scale. Chapter 2. Management evaluation. When you invest in MSTR, you're really investing in an ideology. And that means you have to understand the leadership. Michael Saylor, the executive chairman. He's the architect.
And his personal history is key here. He lost $6 billion in one day during the dot-com crash.
Exactly. So he's seen total catastrophe. For him, a recent dip in Bitcoin to $80,000 is just the cost of admission. He has this iron conviction, and he's incredibly transparent about it. He never wavers.
And while he's the architect, you have Feng Lei, the CEO, who is the operator.
Right. Lei is the one who's actually managed that tricky cloud transition and kept the software business profitable. And he's completely aligned. He says holding cash is just decapitalizing the company.
Which makes sense given their focus on Bitcoin acquisition. But because of that, normal metrics like earnings per share are useless, so they had to invent their own.
They did. It's a proprietary KPI they call BTC yield. It measures the year-over-year growth in their Bitcoin holdings compared to the growth in their diluted shares outstanding.
So it's a way to prove to shareholders that the Bitcoin pile is growing faster than any dilution from issuing new stock or debt.
Precisely. And it's working. It was up 26% year-to-date in Q3, and they're targeting 30%. It shows the financial engineering is actually adding value on a per-share basis.
Chapter 3, Financial Health. We have to be really clear here. Standard PE ratios are completely meaningless for this company. The earnings are just massively distorted.
Especially now with fair value accounting. When they mark their crypto to market, you get these wild swings like that $2.8 billion net income number in Q3. It's not real cash. It's a distraction.
So what should we be looking at instead?
The balance sheet, the debt. They have about $8.2 billion in total debt. But because of that fiat loop, most of it is in those super low-interest convertible notes.
So the actual cash they pay in interest each year is pretty low.
Incredibly low, only about $35 million.
Okay, but even so, the cash interest coverage is a bit tight, isn't it? If you only use cash flow from the software business, it's like 1.5 to 1.7 times coverage.
It is tight.
Yeah.
And that's the main risk. It's not defaulting on the debt. It's a liquidity crunch during a long crypto winter where they might be forced to sell Bitcoin just to cover costs, violating their HODL strategy.
Which brings us to the real aha moment of this deep dive. The sum of the parts valuation, this is where we see the discount.
Right. We have to break the company into its two pieces.
Okay, let's do the math. First, the software business. We're putting a conservative 5 times price-to-sales multiple on its $475 million in revenue. That gives us a value of about $2.4 billion.
Hang on. A 5 times multiple. If subscription revenue is growing at 65%, why are we being so conservative? Peers with lower growth trade for more.
It's a fair question. We're being cautious. We're deliberately pricing in the volatility that the market attaches to anything associated with MSTR. So $2.4 billion for software.
Okay, then the Bitcoin Treasury. That's easy. It's worth $59.25 billion at the reference price.
So we add those two together, subtract the $8.2 billion in debt.
And you get a total net asset value, or NAV, of around $53.4 billion.
And here's the kicker. The current market cap is only $51 billion.
So if you divide the market cap by the NAV, you get 0.96. It's trading at a 4% discount to its parts. The market is basically giving you the software business for free and still pricing in some kind of disaster.
That 4% discount is the puzzle we need to solve. But before we get into why that is, a quick word for you. Like and subscribe to Stock Analytics AI. Part 2. Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
The discount exists because the current sentiment is just extreme fear and polarization. The stock is down 40% from its highs, reflecting this huge risk-off mood.
And the bears have a simple argument. They say the premium MSTR used to have is gone for good.
Right. With spotted Bitcoin ETFs everywhere, they argue MSTR is obsolete. Why buy this complicated company when you can just buy Bitcoin directly?
But the bulls fire right back with that 26% BTC yield number.
They do. They argue MSTR is actively growing your exposure faster than just buying and holding. They're looking for a double whammy return. The NAV goes up and the premium comes back.
If you look at the market indicators, you can see this fight playing out. Short interest is really high, about 27.5 million shares.
That's a very crowded bearish trade. It sets up the potential for a massive short squeeze if sentiment turns. And technically, the stock is deep in oversold territory. The RSI is down in the 20s.
And the craziest part is the gap between the price and what analysts think it's worth. The stock is at 177, but the average Wall Street target is over $500.
It just tells you that the price right now is being driven by fear and technical factors, not by the fundamental value of the assets on the balance sheet.
Chapter 5. Ownership structure.
And a lot of that fear is tied directly to the ownership structure and one very specific date on the calendar.
Exactly. You have big passive funds like Vanguard and BlackRock holding the stock. But it's not because they love the Bitcoin strategy. It's just because MSTR is in the major stock indices.
Which brings us to this huge binary risk,
Yeah.
the MSCI decision coming up on January 15th, 2026.
Right. If MSCI decides MSTR is now basically a crypto proxy and kicks it out of their indices, The fallout is mechanical and immediate.
So what happens then? Explain the mechanics of that. All those index funds that track MSCI, they would be forced to sell. They have no choice. We're talking about anywhere from $3 to $9 billion of stock hitting the market in a very short period.
$9 billion of forced selling. That would absolutely crush the stock price in the short term, even if the assets are still worth $185 a share.
For sure. And that risk, that possibility of forced selling, is almost certainly what's creating this 4% discount we're seeing right now.
But no matter what the stock price does, the core strategy isn't going to change.
Not a chance. Michael Saylor has Class B shares with 10 times the voting power. He has an iron grip. No activist investor can come in and force a liquidation to close that discount. The strategy is locked in.
Chapter 6, Risk Assessment. Okay, so internally, the risks are pretty clear. You have massive concentration risk. Over 95% of the value is in Bitcoin, and you have negative free cash flow.
Right, but we also need to look at the external geopolitical threats, specifically the proposed U.S. tariffs of 2025. These aggressive 50% tariffs on imported hardware.
Now, that feels a bit disconnected. MSTR isn't a manufacturer. How does that affect them?
It's an indirect but profound impact. You have these two opposing forces. First, it hurts Bitcoin mining economics. Tariffs make mining rigs more expensive for U.S. miners. That could depress the Bitcoin price as they're forced to sell coins to cover higher costs.
Okay, so that's a negative.
It is. But on the other hand, it hurts consumer liquidity. The tariffs could reduce U.S. purchasing power by over $100 billion. People have less money, they sell risky assets like Bitcoin.
So you have two negative pressures on the price. Where's the hedge?
The hedge is what happens if those tariffs lead to long-term persistent inflation. If that happens, Bitcoin's digital gold narrative gets a massive boost.
And as the largest corporate holder of Bitcoin,
MSTR would be the single biggest beneficiary of that narrative strengthening. So the question is, which force wins out? The short-term selling pressure for miners or the long-term tailwind from the inflation hedge? It really depends on your macro outlook.
Chapter 7, Conclusion. So when you put it all together, Strategy Inc. is this incredibly unique thing. It's a highly leveraged financial instrument, but it's wrapped inside a growing, stable software company.
And our verdict, synthesizing all of this, is pretty clear. On a pure asset basis, the stock is undervalued by 4 to 5%. We calculated that NAV floor at about $185 a share, and it's trading at $177.
So the key takeaway here for a long-term investor is that your downside is kind of hedged by the actual tangible value of the assets.
It is. While your upside is supercharged, it's levered to Bitcoin adoption and any future monetary expansion, all thanks to that brilliant fiat loop.
So the next 60 days, they're going to be incredibly volatile because of that MSCI decision. But if you have a long time horizon, the risk reward looks pretty attractive right now. You're buying $185 worth of assets for $177.
Precisely. The price is detached from the fundamentals, and that creates a classic, if very unconventional, value opportunity.
And here's one final provocative thought for you to think about that goes beyond the common stock.
Wow.
Strategy Inc. has actually started issuing preferred stock, tickers like STRP, and these preferred shares do pay dividends.
That's fascinating. Why is that provocative?
Because it suggests they're building a much bigger financial ecosystem. They're trying to attract income-focused investors who would normally never touch a crypto stock. It shows that Saylor's financial engineering is just getting started. For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives. Thank you for joining us for this comprehensive analysis into Strategy Inc. If you enjoyed this deep dive, please hit that subscribe button to catch all our future deep dives.
And please remember that the views and opinions expressed in this show are those of the participants and do not constitute investment, financial, or business decisions. The information provided is for educational purposes only.